Cleanmore Appliance has gone through the entire process of keeping its books. They've made their trial balance. They've made their first two financial statements, the income statement and the statement of RE. So they get to prepare, at this point, their last financial statement, which is their balance sheet. We're going to classify this balance sheet. It means instead of just saying assets and liabilities, we're going to break them down into different groups. There's a lot of different classes that you can have on a classified balance sheet. To keep it simple in here, we're going to break it down into two big groups. Our current assets and our non-current assets are our two subdivisions for assets. What makes something current and what makes something non-current, and that is 1 year. Do we reasonably expect to expend or convert that asset to cash within the next year? If we do, it is a current asset. And if we do not, if it's something we plan on using for more than a year into the future, it becomes a non-current asset. So let's go back to our worksheet and look at our list of assets. We have cash, equity investments, finished goods inventory, WIP inventory, raw materials inventory, accounts receivable, supplies, and a fair value adjustment at the beginning. All of those things we could reasonably expect to convert into cash within the next year or expend and use up. I mean, cash is already cash, so that's got to be a current asset. Equity investments, you have the option of placing it as current or non-current depending on what you think is your most reasonable expectation for it. We've already sold some of that equity investment, so I think we're willing to sell it if the price is right. We should list it as a current asset because there is a better chance than not that we are going to convert it to cash within the next year. Our inventory, we're hoping it doesn't take a year to sell an appliance that we make, so that should be a current asset. Accounts receivable, we're hoping that we collect on that debt within the next year. Supplies, etc. Fair value adjustment goes, because it's tied to our equity investments, wherever equity investments goes. So that grouping right there is our current assets. The other assets that we have on the books are our building. I think we're going to use that for more than a year. We're not going to tear it down at year's end. Equipment, again, we're probably going to use that for more than a year. We're not planning on tearing that down at year's end. And then we have HTM debt investments. Again, HTM stands for held to maturity. So if you put it as current or non-current, if it's classified as a held maturity debt investment, what classification you use depends on when it matures. So way back into our journal entries over here, if we scroll up until we find this guy, when we bought this thing, they are 5-year corporate bonds. We're planning to hold them to maturity. It's only been a quarter, so that means there's way more than a year left until that thing matures, which means since we don't expect to convert it to cash within the next year, it should be classified as a non-current asset. So going back to our balance sheet, we've got a pretty good breakdown over here. The first thing that we know that we're going to use, according to our worksheet, is cash. So we're going to throw cash up in there. I am using the 3-column approach. As you can see, there's a B, C, and D here for 3 different columns. The rule of thumb is if the item stands alone by itself, like it just has a value, there's no accounts tied to it, you put it in the middle column. If there is an account tied to it, either a contra or an adjunct account, you put both of those accounts in the leftmost column and then the adjusted number in the center column. And then the right column is just for totals. So that amount that we have for cash, I'm going to put in the center column, column C. I'm going to equals, I'm going to go to the worksheet, and I'm going to grab that balance from over here. Again, usually you don't have pennies on a financial statement, so we rounded that to the nearest dollar. The next thing that we've got up on our list, we go to the worksheet that's a current asset. We have equity investments listed over here. Let's bring that on over. Equity investments, back to our worksheet, does have an account tied to it, that fair value adjustment. So when we place that number onto our balance sheet, we should put it in the left-hand column. What we are saying here, after I grab this number, is that our equity investments are being carried at a cost basis of $2,187,500. However, that's not their fair value, and GAAP allows us to adjust to fair value for assets that we think we could reasonably sell that are trading assets. And that fair value adjustment that we want to bring over as soon as I find it right here is $1,050,000. It's tied to the other account. We're going to put this in the left-hand column with it. So what these numbers mean to the user of your financial information is that your equity investment, your in our case, our stock in Eddy, is being carried at a historical cost of $2,187,500. However, if we sold it right now, we could sell it for $1,050,000 more than that. So if we add those two together, we get the adjusted amount. Reasonably, if we sold our investment in Eddy today, we could sell it for $3,237,500, which is the number we're going to display on our financial statement. Hitting equals and going back to our worksheet, we have three inventory classes. We got finished goods, WIP, and raw materials. I am going to go and I'm going to use the fill handle to bring all three of those over. These are all accounts that stand by themselves. I have seen before in the past where people put inventory total and then they display the breakdown later, but we're going to do it this way. In the middle, we're going to have equals, go back to our worksheet, grab the amount for the first one we listed, which was finished goods at $600,000. And then I can use the fill handle here to bring over the $400,000 from WIP inventory and the $500,000 from raw materials inventory. We got more assets left, so I'm going to hit equals over here. I'm going to go back to my worksheet. And I'm going to see that we have accounts receivable on the books and supplies, our last two current assets that we have not yet listed. So I'm going to bring over AR. I'm going to use the fill handle because supplies is right underneath it to grab supplies. And then for their balance, I'm going to go back to the worksheet and I'm going to bring over the $1.8 million we have in accounts receivable and then use the fill handle to grab that $100,000 of supplies. And there we go. And my line disappeared, so I'm going to throw it back in with the bottom border. Here we have total current assets. What are our total current assets? Well, it's just equal to the sum of everything that we listed in the center column. If we add up the value of our cash, our investment, our inventory, our accounts receivable, and our supplies, we find that Clean Water Appliance has just over $14 million worth of assets, which they expect to expend or convert to cash within the next year. Moving us on to our non-current assets. And if I hit equals and I go back to the worksheet, I see that the first non-current asset that we have listed here is our buildings. And our buildings have an account tied to them. So we're going to put the historical cost of that building in the leftmost column, go back to our worksheet, and we're going to grab that $4 million, which was the cost basis. It's what we paid for the building in the first place, counting in our down payment and the mortgage that we signed. However, that building is not worth $4 million today because we've used it. It's lost some value. We get to expense it over time. Underneath it, I'm going to type this in. We want to let users of our information know how much value our building has lost. So I'm going to hit equals. I'm going to go back to the worksheet. And I'm going to find the value of ACT UP buildings, which is $45,000. And to find the difference between those two, or find the balance of those two, the adjusted amount for those two, I just add them together. And now we got a problem. What my numbers, as they stand right now, are saying is that building cost us $4 million. We used it, and somehow it went up in value over time. What's wrong here? Accumulated depreciation should not be increasing the value of an asset. It's taking value away from the asset. That number should be displayed as negative. So I'm going to go back up into the formula bar. I'm going to put a negative sign after the equals and before the W in worksheet. And now that makes much more sense. Our building was worth $4 million. It lost a little bit of value. Right now it's worth $3,955,000 on the fair market. The next thing that we have to grab, I'm going to hit equals again, go back to my worksheet, is our equipment. And our equipment also has an account tied to it, so I'm going to throw it in the left-hand column. And our equipment is worth $2.8 million. It has also lost value. It has an accumulated depreciation account, so I'm going to type in less ACDEP for short equipment. And since I know I want this to be negative, and now I'm going to set I just hit equals, I'm going to hit equals and put a negative sign to save myself a step here. Go back to the worksheet, and I'm going to grab that $15,000, which will display as negative, to find the book value, what our books say it's reasonably worth right now on the open market. I add those two together, And the fair value of our equipment, according to our books, is $2,785,000. The last thing that we need under our current assets is that HTM debt investment, that held maturity debt investment. There is no account accompanying HTM debt investments. You're not allowed under GAAP policy to revalue any assets, any investments that you're planning on holding on to for a long time. Like, they have to be trading. You have to reasonably expect to sell them if you want to adjust their value. So all we got to do now is just bring over that balance into our center column. It is $500,000. So in total, our non-current assets have a value equal to the sum of the middle row, which is $7,240,000. So what do we have for total assets? Well, we've got a little over $14 million in current assets, plus we have $7,240,000 in total non-current assets. If we add those together, we come up with total assets of $21,333,673. Left side of the balance sheet done. Moving on to the right side, which again, we are going to separate in between what liabilities we expect to have to pay within the next year and what debt is on our books that we're not going to begin to pay on for more than a year into the future. Well, what do we have on our worksheet? And two pop off to me right off the get-go. We have accounts payable and salaries payable. Accounts payable stems from buying stuff from vendors. Probably it's where we get our materials for our inventory from. I don't think our vendors are going to be very happy if we don't make a payment to them within the next year. I don't think our employees are going to be very happy if we don't pay that $30,000 we owe them in salaries within the next year. So those two items, in this case, should be current liability. So I'm going to go and I'm going to bring them into my current liability section. We have accounts payable, and then I'll fill handle to grab the salaries payable that I want. Nothing is tied to these, so they go in the center column. So accounts payable has a balance according to our worksheet of $350,000, and salaries payable has a balance equal to, according to our worksheet, at $30,000. Those two liabilities are entirely current. Like, we owe that full balance within the next year. The other liabilities that we have on our books, we have a bonds payable, a notes payable, and a mortgage payable. Are those all long-term debt? Yes, but sometimes no. There are chunks of this that we're not going to pay on within the next year, but specifically for our note and our mortgage, if we go back to our amortization table schedules over here, we have to make payments. We're making these statements on the 31st of 23. We have to make payments within the next year. Same thing with our note. We have to make a handful of payments here within the next year. So for your note and for your mortgage, you actually need to separate out that amount that you owe into what portion is due within the next year and what portion is due more than a year into the future. For bonds payable, it's much easier though, because bonds you don't pay in chunks. You pay one big lump sum. In our case, we're going to pay $2 million back at the end of 2027. The entirety of that is long-term debt. We don't have to make any principal payments within the next year on our bond. So let's knock out the, the portion of our long-term debt that is current. So I'm going to have current portion of notes payable, and I'm going to have current portion of mortgages payable that needs to go into here. Now we got to figure out what we owe. Well, let's go back to our amortization table. We'll start with the note. Again, we are preparing these on March 31st of 2023. What payments are we going to have to make within the next year? Well, that June 30th of 23 payment, that's occurring within the next year. The September 30th of 23 payment, that's within the next year. December 31st of 23 within the next year. And that March 31st of 24 is exactly 1 year from today. So we have 4 payments that we have to make within our next year that should be classified technically as current. When you do so, yes, we have the total payment amount, but GAAP states that you can't include expected interest charges into your liability. We're not carrying this thing on our books, inclusive of the interest we're going to have to pay. All of these numbers are all stemming from principal. So going back to the balance sheet, what I'm going to do here is for the current portion of notes payable, I'm going to hit equal sum. I'm going to open a parenthesis. I'm going to go back to the worksheet. I'm going to go back to the amortization table, and I'm going to figure out what amount is going to be applied towards principal in the payments that we're going to make within the next year. We're going to have to pay that on June 30th, $50,000 going towards principal. Same is true for September 30th. Same is true for December 31st, and the same is true for the payment we make 1 year from now on March 31st, 2024. So for the 4 payments that we have to make within the next year, we are going to have to pay $200,000 towards principal. So if I hit enter, there it goes. That's our number showing up. If you get this little funky arrow up in the corner, it's because the way that you brought the cell in doesn't match the formulas that are next to it. You can just get rid of it by hitting the drop down bar and hitting ignore error, and it'll get rid of that guy. In that same concept, what we're going to do now is we're going to go type equal sum. We're going to go to our amortization table for our mortgage and figure out what portion of all of the mortgage payments we're going to make within the next year is going to be applied towards principal. So going back here to the amortization table, scrolling down to our mortgage. Again, we are preparing these on March 31st, 2023. So what payments are going to be incurred or need to be made within the next year? It's not by circumstance here that your payments ended on March 31st of 24. I gave you exactly enough to figure out what amount of mortgage payments are going to be applied towards principal within the next year. So what's going to be the sum that we have? Well, we made these 3 payments. They're already on our books, which means our payments that are due within the next year, since this is monthly, is our next 12 payments. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. The principal amount in total that is going to be paid on our mortgage within the next year, all of our payments from April 30th, 23 to March 31st, 24, is equal to $81,301. So assuming that we're going to pay off our accounts payable and our salaries payable within the next year, and we're going to make $200,000 worth of principal payments on our note and a little over $81,000 of principal payments on our mortgage, the total current liabilities we have is equal to the sum of those numbers is $661,301. What about long-term debt? What do we have here? Well, we have, if we got the current portion of notes payable, we have the long-term. I could type long-term portion of notes payable. And we're also going to have our long-term portion of mortgages payable. This is much easier to calculate. We're going to put this right in the center column. We're going to hit equals. We're going to go back to our amortization table. I forgot the L in payable. Hold on. Let me fix that situation too. There we go. Let's go back to our amortization table and find out what amount of principal is still going to need to be paid on our note more than 1 year into the future. So if I go to our amortization table and I go to our notes payable, we said that every payment up until March 31st of 2024 is going to be current. Well, what is the balance that's still going to be owed after we make that March 31st, 2024 payment? We have that right here. Ending balance tells us that after we make that payment, we're going to owe $350,000. So I'm going to enter, and I'm going to bring that back over. And I'm going to take a quick detour to our T accounts, or even our worksheet really fast. The balance right now of our notes payable is $550,000. Does that make sense with what we just put on the balance sheet? It sure does. We said $200,000 of that is due within the next year, and the remaining $350,000 is due more than a year into the future. But your current portion and your long-term portion of any piece of long-term debt should always add up to the balance that you're carrying it for on your books. So let's apply that same concept to our long-term portion of mortgages payable. If we go to our amortization table, we said that, all the way through March 31st, 2024 is the current portion. So the principal that's still going to be remaining on our mortgage after we make that payment on March 31st, 2024 should be classified as non-current. And what is that amount going to be? We have that here. It's the $2,899,122.28. I'm going to bring that number on over. And again, for the sake of fun over here, let's just make sure our numbers work out. I'm going to make this column a little bit bigger to check. We know that our balance of mortgages payable on our books should be equal to the current portion we're displaying and the long-term portion that we're displaying. And that together adds up to $2,980,424-ish rounded off. What is the balance that we're carrying that for right now? We are carrying it for $2,980,423.65, which Excel rounded up to the nearest dollar. So we're good. We've accounted for all of that. We have one more piece of long-term debt that we have to display, which we didn't have to separate, and that is our bonds. So let's go and grab our bonds payable from our worksheet. Our bonds, back to our worksheet, have an account tied to them. We're carrying them at a premium right now. And again, if you have an account tied to another account using this 3-column approach, you should put the balance of both accounts in the leftmost column and then put the adjusted number in the middle. So bonds payable is being carried at a balance of $2 million. And that bond has a premium, according to our worksheet, of, putting this in the left-hand column, $57,000. Premiums increase the amount of debt. We would have to pay more than $2 million if we wanted to pay off these bonds early, because our investors give us more than their face value up front. They're going to want that money back if we decide that we don't want to pay them interest anymore. So for a premium, you add them together. Again, if this was a discount, it should be lowering the value. So if it was a discount, you want to display that number as negative before you add them together. But for Cleanmore, in total, their long-term debt totals up to $5,306,122, and their total liabilities, everything they owe either within the next year or more than a year in the future, add together to $5,967,424. 2 of our 3 sections of the classified balance sheet are down, leaving us our last section, which is stockholders' equity. What equity accounts do we have? We've got common stock par. Let me scroll down a little bit here. We have PIK common. We have preferred stock. We have PIK preferred. We have treasury stock. We have PIK treasury. We have unrealized holding gain, and we have retained earnings. All equity accounts that are going to have to get displayed in this spot somewhere. I gave you a line to fill in, which is total paid in capital. That's the total amount of money that came in from outside users to buy ownership in your company, which means anything that is either a stock account or a PIK account related to a stock has to go into this area, with one exception. Treasury stock common, or treasury stock preferred if you have it, neither type of treasury stock counts towards paid in capital. Why? Because no one paid in for you to have that treasury stock. You paid someone else to buy it back from them. So what accounts are we going to need here? Bringing them over from our worksheet. We're going to need common stock, PIK common, preferred stock, and PIK preferred to start with. So I'm going to use the fill handle to bring in those 4 accounts, 2, 3, and 4. The other thing that we're going to need is our PIK treasury, because that's what you get from reselling treasury shares. But you're the ones getting that money. People are paying into your company to acquire ownership. Just now, we're not issuing for the first time. You're selling them out of treasury. But it's still a method of increasing the value of your business and the capital that you have to work with by selling your stock. So PIK treasury goes in there. It'll always be the same 5 accounts that show up in your total paid in capital. Nothing's really tied to these. Yeah, I know common stock and PIK are kind of tied together, but they're separate accounts that we have. So what we're going to bring in is all the numbers for these accounts that we have displayed on our worksheet. Common stock, according to our worksheet, has a balance of $1 million. PIK common is 10.2 million, preferred stock is 1,250,000, and we have $250,000 in PIK preferred. I'm just going to bring the first number over and then fill handle in those other three. And then for our PIK treasury, going back to our worksheet, we see that it has a balance of 450,000. So I'm going to bring that number over too. I don't know why I've got decimal places showing here, but we can get rid of them by using these things. These are increase and decrease decimals. So I want to decrease the decimal to get rid of those guys right now. And if we add those up, our total paid in capital is equal to the sum of those numbers. All in all, outside users who are now our owners, our stockholders, paid $13,150,000 in total to acquire ownership in our company during the period. And we've used that to buy assets and to conduct operations and all of that fun stuff. We're going to display that as our total paid in capital, which now we got to throw in our other equity accounts. And I'm going to start with treasury stock. Less treasury stock common. Treasury stock, shares that you're still holding in treasury that you've not resold, actually decrease the value of the business for your shareholders because you, the company, owns that portion of your ownership. Somebody else does not. So we're going to display this as a negative number, so equals negative. I'm going to go back to my worksheet, and I'm going to grab our balance of treasury stock common, which is 225,000. The other accounts that we have on here that we need to bring in are our retained earnings, which I'm going to go and I'm going to grab that account as soon as I find it, and our unrealized holding gain. So let me bring that number over too. Starting with retained earnings, what number do you use? We've been grabbing numbers off the worksheet the whole time. This is the same thing I tell my financial accounting students. It's the same thing I still tell my intermediate accounting students, etc. It's an easy mistake to make. You grab every number from your balance sheet, from your worksheet, except for one, and that is your equity value of your business. In this case, our retained earnings. Where does that number come from? That was the whole purpose of us making that statement of retained earnings in the first place. So that number should come from the bottom line of the prior made statement of retained earnings. And then lastly, we have our unrealized holding gain. Why does unrealized holding gain go into equity? Well, equity is about the value of the business. We didn't sell our shares in Eddy to increase our profits by a little over $1 million. But had we, our income would have been higher, and that income would have flown into retained earnings, which ultimately gets displayed here. So you can think about unrealized holding gain as an account that complements your retained earnings account. It's how much higher retained earnings could have been had you actually realized that gain. So I'm going to hit equals, and I'm going to go back to our worksheet, and I'm going to grab that unrealized holding gain of $1,050,000 and bring it on over. And now we got to find our total stockholders' equity. And that is equal to the amount that was paid in capital less the amount we're holding in treasury plus our retained earnings plus any realized gains that we have. So it's basically just the sum of the four numbers up above. And when I add those together, I come up with $15,366,250. And this is the point where every accounting student that you have is going to take a big, deep breath. We're going to add together our liabilities, and we're going to add together our stockholders' equity, and pray that it comes out to the same number as our assets, and lo and behold, it does. Real fast, I realized that you have 24 here and 50, so I should add together 74. Again, it's a rounding thing. Don't worry about it. It's all about, does the bottom number come out to be the same? It does. We're feeling good about ourselves. Our balance sheet is done. It balances. We're ready to display this to whoever wants to see our information. And at this point in time, we would start closing our books. We would close all of our temporary accounts, our revenues, expenses, withdrawals, etc. I'm not asking you to do the entire closing process and prepare a post-closing trial balance. I just want one entry. So after you've finished your classified balance sheet, your last step on here is actually going to be go back to where we all started on the journal entries, scroll down to the bottom, and we're going to close our retained earnings, or close our cash dividends account, to retained earnings for the period. And to do so, you debit retained earnings and you credit cash dividends. And you do this for whatever the balance of your cash dividends account is. Well, what is the balance of our cash dividends account right now? We can go to our T's. We can go to our worksheet where we can find them. I'm going to go to the T. And we see that cash dividends has a $408,750 debit balance. Well, how do we get it to zero? We're going to have to credit it for that same amount. So let's credit that account for $408,750. And then since debits have to equal credits, we know that's what our retained earnings have to be as well. So we bring that number on over there. And here we closed cash dividends. And then lastly, we can throw those into our T accounts. So we have, for retained earnings, a debit to retained earnings equal to $408,750, which I'm going to bring over to our T account. This has occurred on March 31st, so 3/31. So now, what should the balance of our retained earnings be? Well, it's an equity account, and like all equity accounts, you find it by taking the sum of your credits and subtracting out the sum of your debits. And that balance, according to our T account, will now come out to be $1,391,250. Does that number look familiar? It absolutely does. Your balance to retained earnings at the end of the period in your T account should be equal to what you're displaying as your ending retained earnings balance on your statement of retained earnings. As far as the other side of that journal, going back over here, we just credited cash dividends for $408,750. So the balance of that account, as we see down here, is now zero, as it should be. Like all temporary accounts, you want to reduce them to zero at period's end after you close, and we have. And with that, we're through the review process for your fourth comprehensive assignment.